Good morning, everyone. We are going to continue our discussions about conceptual framework for financial reporting that we said in a lot of occasions that this is the bedrock or foundation or background of our accounting standards, which we will discuss in detail as we go along the way. So I love this particular illustration here that you can see on your screen because this shows you or us an inverted pyramid or triangle which shows the three levels there are in conceptual framework for financial reporting. So we can see at the bottom the first level, although we can also see some illustrations in which the pyramid is really from the bottom, the bigger part going to the top, which is the slimmer part, and the pointed end is at its top. However, we will just respect this one probably because the objectives are like the lesser part, it's the first level, and then this is the why, the goals and purposes of accounting. After that, we have the second level, which is the bridge between levels 1 and 3. So we can see here the qualitative characteristics of accounting information. So we have discussed them already. As a review, we said that these are the fundamental characteristics and the enhancing or enhancement of characteristics or enhancing characteristics. Then elements of the financial statements from assets down to expenses. These are already discussed in the previous part or the first part of conceptual framework for financial reporting. And we have here the third level, which is now the how implementation. So we talk about recognition and measurement concepts. Then we have the assumptions, principles, and constraints. All right. So we will discuss now the third level, the how or the implementation that we do in financial reporting. So I'm still going to make use of our source, which is Milan, for our discussions. All right. So the first stop is the recognition process from recognition and derecognition. If we say recognition, that means basically the process of including in the statement of financial position or the statements of financial performance an item that meets the definition of one of the financial statement elements. That is asset to expense. All right, so we have known already what these financial statement elements, also known as accounting elements or values, are. So recognition is basically the process of including the inclusion of these items on the financial statements. We put some words, yes, this is correct. For those who are done with their accounting fundamentals, so they have known that this would be in the form of a journal entry with a debit and credit, since recognition is also known as journalizing or recording. So these are the three synonymous terms. Hopefully you're taking that down. Recognition, recording, and journalizing. Then this also includes putting some amount or monetary amounts on the journal or with the journal entries. So words and amounts. Then including that amount in the totals of either of those statements. Of course, whatever comes to those financial statements would form part of the total. And this is recognition. Question is when? So there are two items or criteria, and this is an and. We can see meaning we have to satisfy both of them. To be recognized, letter A, it should meet the definition of asset down to expense. That is a requirement. So there should be a debit of any accounting element. That's the value received. And the value parted with or given or credit is also any of the accounting elements. Then letter B, recognizing it would provide useful information. Of course, it would touch the fundamentals. We have the relevance and faithful representation. All right. So at least the fundamentals are there, as we said, because without the fundamentals, enhancements or enhancing characteristics would be useless. All right. As a review of relevance, we said that the inclusion of the information would lead to differences as to the decision making that the users would be giving. So these users are our stakeholders on the financial statements, whether internal or external. Now, the recognition of an item may not provide relevant information if, for example, letter A, it is uncertain whether an asset or liability exists. So basically, there is a question as to whether the two accounting elements are there, or they're there, but the probability of an inflow or outflow of economic benefits is low. So let us scrutinize this one. If we say probability, this means that the possibility of an item or an accounting element to happen or occur is greater than the possibility that such would not happen or occur. So example, if a certain asset would exist 51% and it would not exist 49% possibility. So we have to recognize that because its probability of existing is greater than the possibility that it would not exist. I hope that is clear. So if we say inflow, it means the plus. The outflow is the minus. So it's not clear the possibility for it to happen or occur is lower than it would not, right? Or the possibility that it would not happen is greater than it would. So the opposite is true because the probability is low. So that's why there could be some question as to the relevance. However, we have to take note, this is from our conceptual framework, that in the event that one or both does not happen, then we would not automatically say that there wouldn't be any accounting element or item that would be recognized. So that's why other factors should also be considered. So that's the point of this part here. You can also notice this is an or, so meaning any any of the two would exist or both would have a question of recognition, but we should not be automatic in the judgment. So other factors should also be considered. All right. What about for faithful representation? In that case, there could be some level of measurement, uncertainty, and other factors which can affect the item's faithful representation, but not necessarily its relevance. So faithful representation is inclusion of the information that would affect the decision making of the users. Relevance would make difference, of course. Now, if there's measurement uncertainty, which means that an asset or liability needs to be estimated. So uncertainty question, like we do not know the exact value, hence we do the estimate. However, again, we said that in making estimates, it should be or they should be professionally made, not just personally made. A high level of measurement uncertainty does not necessarily lead to the non-recognition of an asset or liability. If the estimate provides relevant information and is clearly and accurately described and explained. I think that's clear that it doesn't mean that because there is a question as to the amount and we do the estimate that we would not recognize the asset or liability. All right. Why is there an emphasis of asset or liability? That could be a question. What about the other accounting elements? It's because if you have known the asset or liability, normally the counterparts would be having the same amount. Because in accounting, both sides should be equal, the debit and credit. Another bullet. However, measurement uncertainty can lead to the non-recognition if making an estimate is exceptionally difficult or exceptionally subjective. Yeah, that is true. Difficult, really exceptionally. So with all due efforts being made, it's really difficult to do the estimate. And it would be really requiring personal opinion or judgment than professional one. That's why it is exceptionally subjective. In that case, the non-recognition would be warranted or would be allowed or would be considered. All right. Then what about the opposite? If recognition is the process of inclusion or including in the financial statements an item or an asset or liability and the other accounting elements, especially asset or liability in the statement of financial position, formerly known as balance sheet, then the opposite, which is the removal of them or non-inclusion, is the recognition. The recognition occurs when, of course, an item does not meet the definition anymore of the asset or liability. All right, so before we go into that, of course, the recognition would also happen when the recognition principles of asset and liabilities would not be satisfied anymore. So we will know that there are recognition principles of the asset and liability like two. So the first one would talk about that it is probable, for example, that the economic benefits embodied in the asset will flow to the entity. So this is about the economic benefits and the probability. And the second is the amount. So any of the two not satisfied, especially for the economic benefits, which would no longer there for asset, would probably result to the recognition. So the point is that it is not automatic again that just because any of the two would be or both would be non-satisfactory that we are now going to recognize automatically. So we just have to determine the extent of non-satisfaction of the accounting element anymore or further. All right, the next one is unit of account. This is the right or group of rights that is for the assets. The obligation or the group of obligations that is for liabilities, or the group of rights and obligations, a combination of assets and liabilities to which the recognition criteria and measurement concepts are applied. All right, so basically group of assets, liabilities, and both assets and liabilities. Next, measurement basis. So we have touched them in overview of accounting. So we have the historical cost, the current values. Then we have already mentioned them, so hopefully you've visited, but they will be discussed here anyhow. Okay, let's go further. Historical cost is the amount of the asset that was paid for it for acquisition, including the transaction costs. So these costs are needed so that the asset would be ready for its intended use. So for example, if we acquired a machinery, then all costs needed so that the machine can be used will be forming part of the asset. And the liability would be all amounts paid for that or them and minus the transaction costs. So the opposite of asset. Historical cost anyway is outdated for sure as we go along the way in our business. That's why it would be updated by the following items. So this would normally be the minuses, guys, if you are going to notice depreciation, which is the decrease of the value of a certain property, plant, and equipment item like building because its functional capability has diminished or decreased over time. So that is the systematic and rational allocation of the PPE. However, that will be discussed as we go along the way or in your other accounting subjects. So collections, payments, these are deductions of assets or liabilities and amortization or unwinding of discount or premium. So updates. For some, minus, normally minuses for 1, 2, and the unwinding of discount, premium also would be minus. All right, what about fair value? If we go to a market and the price has been determined by two willing knowledgeable parties, both buyer and seller, in an orderly transaction, so that's the fair value. After that, we have the value in use, which is the present value of the net cash flows of a certain asset. So when we dispose, for example, we sell an asset, how much would be the expected present value of the cash flows that would be generated from the use up to its ultimate disposal. So meaning we have to estimate as to how much really would that asset bring us in a future time, but we have to compute it at time zero, and then that would be our amount to be considered. Fulfillment value is the opposite of value in use. This is for obligation. So how much would be the value at time zero of a certain payment that is to be done in a future time? Thus, we can say that these two values are the opposite of each other. I repeat, value in use is for your asset, fulfillment value is for the liability. Then current cost is also for asset or liability. For the asset, let's say there's a table that was already existing for 10 years. How much would the cost of that particular asset if it is acquired in the current time? That is current cost or the present time, like today. Liability, on the other hand, is the amount by which we will be paying that liability, which was already existing years ago, and then at the current time. That is the current cost. So if we talk about fulfillment value versus current cost, fulfillment value is to be able to fulfill the promise to pay a liability. But the current cost is how much would be the value that we would be receiving for that liability at the current time. So that's the opposite of fulfillment value for current cost and liability. Then what about entry values versus exit values? So knowing the four values now that we have talked about, namely historical cost, fair value, then you also have the value in use and the fulfillment value. That's the second, or let's say those are the mentioned items that would be the opposite of the next. So that's what I meant. So like there are two items talking about such. Okay, so let us go back to that part so that we will not be lost along the way. So yeah, value in use and fulfillment value. So meaning those are the two. The second would be the opposite of the next fulfillment value, in which the current cost of liability is the opposite. All right. So the fourth one is current cost. I repeat, that's historical cost, fair value. Then you have the value in use and fulfillment value and the current cost. So those are the four groups of items. Now let us determine like which of the four would be entry values and which would be exit values. If we say entry values, so basically these are the items in which they have to be actual or estimated that the asset or liability would be included on the financial statements at the onset. That's why it's called entry. So the first time that the values are included on the financial statements, hence historical cost and current cost. So acquiring an asset or incurring a liability. For historical, that could be first time, or update. So later on, updates of that, and a current cost is clearly an update of that because it is the value at the current time. However, fair value, value in use, and fulfillment value are exit because they are now the values in which they would relate or connect to the transactions that we consider rather as exits, on the sense that these values will be the ones that we need to, or we have to pay a liability, or we are going to get when we sell an asset in an orderly disposal. So in other words, what I'm saying is that for the entry values, it would be the asset are, or the assets rather are still to be used by the company, or the liabilities are being incurred, or liabilities are being recognized because of acquiring certain assets or getting the money out of loan proceeds, whereas the exit values would be the values in which we would be letting go of the asset and the liability. By the asset, we sell such, or assets, we sell them, or liability or liabilities, we paid or pay it or them. All right, so I hope that is clear what is the difference between entry and exit. If we can notice entry, what would make something to be recognized? If not for the first time, then later on as an update. So the current cost and historical cost, because they talk about acquisition and incurrence of either asset or liability. But the exit would be which transactions and values that would connect to these particular accounting elements, assets and liabilities, to be removed or recognized from the financial statement. So we are talking now about fair value, which should be in a sale transaction in an established market, then value in use and fulfillment value for the asset and liability respectively. Right. So just to emphasize the difference between the two. Then considerations when selecting a measurement basis. So we have to know the nature of information provided by a particular measurement basis. So where is that coming from? And then we have to know the impact of choosing. So example, if that is historical cost for an asset, we have to know that the subsequent recognition would involve depreciation or impairment to update the values of the asset. But the fair value, so we know that the values would change along the way based on the values in the market. That is why rather there would be gains or losses. And then letter B, the qualitative characteristics, the cost constraint, and other factors. So aside from the peso amounts or the values, we also have to check if ever the characteristics which are descriptives or words are also considered. Example, this is for example, EG stands for exempli gratia, which means, for example, a particular measurement basis may be more verifiable or more costly to apply than the other measurement basis. Although this could be a consideration cost constraint because we want that the benefits should be greater than the costs. However, if the costs would be greater at the onset, but in the long run, the benefits would be very big. So even if it's costly, we have to follow it. So that's the point also. If we say cost benefit, the cost should be overall and the benefit should be overall. So up to that time that a particular asset or liability would be acquired and used and incurred and settled for asset and liability again respectively. Okay, next, measurement of equity. So equity is the residual value, as we said, meaning the residue or the difference, what is left when we deduct liabilities from the assets. So that's why total equity cannot be expected to be equal to the entity's market value, nor the amount that can be raised from either selling or liquidating the entity. The reason is, a while ago we talked about different measurement bases. So combinations of various assets and liabilities found in the financial statements, namely or specifically the balance sheet or statement of financial position, emphasis on assets and liabilities, plus the equity, which are the three accounting elements or values found on such. So the equity cannot be expected to be equal to the MV or market value because the values found there are combinations of different values. And also the liquidation value by selling. So this is for assets, value in use, for the liabilities, fulfillment value. Now, equity is generally positive. So we think that because assets are greater than liabilities, and that's what we want to happen, so equity is also positive. Although some of its components can be negative, yeah. And in some cases, even total equity can be negative, in which the liabilities exceed total assets. Yeah, that is true now, especially in times of bankruptcy or insolvency. The liabilities of the business are greater than the assets. All right. So that's something that we have to know about equity. Next, in presentation and disclosure, we are going to talk about certain information that we prepare to basically add more information or disclosures about the items found on the financial statements or the FASes. Now, take note that the presentation and disclosure items, especially the disclosure ones, would be found in the notes to financial statements. The notes and financial statements would show us more information. However, it's not something, I mean, the notes to financial statements is not an inferior financial statement compared with the others. It's having the same quality, it's having the same level. So it is, of course, of the same, let's just say, value out of the other financial statements. All right. Effective communication makes information more useful, of course. So we have to present information that would be meaningful, useful, relevant, faithfully represented to our stakeholders or users of financial statements. So effective communication requires a focusing on presentation and disclosure objectives and principles rather than rules. There could be some rulings that we have to do this, that, and the other. However, in financial accounting and reporting, we think of our objectives and principles that what information should be needed for the sake of the users. Then layer B, we have to group similar items and we have to separate the dissimilar items. So that's something that we can also consider. Then that's classifying information by grouping similar items and separating the dissimilar items. All right. And then layer C, this is for aggregation. The concept of aggregation is that we are going to combine or we are going to group similar items. So in this case, it is closely related with P, but there's just an additional information that it is not obscured either by excessive detail or by excessive summarization. That's something that we have to take note because we might be grouping them in such a way that the details are hidden. That's excessive summarization. So like a lot or majority of the information is summarized or very summarized. And then some of the details are also very given or provided to the point that it is no longer readable. So in other words, there has to be a balance of details and summarization. Then the objectives are specified in the standards. It's there in the discussion. The principles, as said again, the objectives are there in the standards. The principles would include the use of entity-specific information. So although there are some suggestions given in the standards or even in the conceptual framework, however, the information could be getting more entity-specific, especially if that entity is having peculiar nature or let's just say something that is not on the general one. So we need to really study the background and include such on financial reporting. Then more useful that or then standardized descriptions. Yeah. So entity specific is more useful than the standardized, in which the standardized would just depict the general. And of course, the duplication of information is usually unnecessary. That's true. Information which is redundant would just be adding space, should be consuming space, but then it does not add additional value or let's just say it does not provide value added information anymore. So that's why it should be removed after analyzing that it is unnecessary. That's a point. Then classification is, as what I said, and when we combine similar items and we have separated or we separate the dissimilar items. Then another point here is offsetting. Now, it is not allowed that assets and liabilities are to be offsetted or deducted or netted with each other. The assets and liabilities should be presented separately on the financial statements because they have to be shown or highlighted. Although offsetting can be allowed in certain situations. Next, classification of income and expenses. They are either part of profit or loss, which is the normal one, if they're part of the operations or main line of operations of the business, or OCI or other comprehensive income for certain transactions. Then aggregation, that's what I've said already. We have to combine or add accounting elements having the same economic characteristics. Then finally, this is the concept of capital and capital maintenance. Oh, we're almost there, ending. If we say capital, of course, that means the equity, that means the net assets, because basically, if there's a word net, that means that that is an output of a subtraction process. So there is a minus of it or out of it. And so, for example, if we deduct liabilities from assets, the result would be net assets. So that's why we said capital, equity, net assets, or some finance books would be showing net worth. So these four terms are similar. Now we have the two concepts. If we say financial, that basically means that the concept of capital is talking about money or purchasing power. So capital is synonymous with these terms as what I've said. So this is going to talk about that if there is an additional value of the money or invested purchasing power in a business, then that means that there is profit. But if that capital decreased or capital decreased along the way, either again invested money or invested purchasing power, which is still talking about financial, then there is loss. That's financial concept of capital. On the other hand, if we say physical concept of capital, this means that if the entity's productive capacity, if we talk about units of output per day, so for a manufacturing concern or merchandising concern or agriculture, so the products like goods specifically for them, physical or tangible products, which are being sold per day. And if that is a service concern, for example, a massage parlor or let's say a barber shop, then the number of services sold per day, if the number of outputs at the beginning is lower than at the end, or the end is greater than at the beginning in terms of units of output provided or produced or given per day or delivered, then there is profit. But if the opposite is true, then there's loss. So that's the difference between financial concept of capital and physical concept of capital. Financial capital will talk about money. Physical capital or concept of capital will talk about production. In terms of the maintenance, so to maintain, we must have equal capital at the beginning, money, or the production. But to have profit or loss, to have profit, it should have higher value than before. But if there is lower value than before, so there is a loss. All right, so that's the end of the conceptual framework for financial reporting. I hope you learned something out of our session, and I wish us all well. Then I'll see you next time, and let's hear more information for another discussions here. Thank you very much for listening.